Hello and welcome to Financial Intelligence. In this video, I want to talk about the free trading platforms such as Robinhood and show you that they're not free at all. There is no free lunch and there are hidden costs to the users that are not explicitly mentioned in their marketing statements. In this video, I'm going to use Robinhood as an example, but there are many others out there. I'm going to talk about three topics. One, what is Robinhood's business model? Number two, what do market makers do and what is their business relationship to Robinhood? And number three, how does Robinhood charge commission through hidden costs? Number one, Robinhood's business model. Robinhood is an online investment and trading app launched in 2013 that claims to offer a commission-free model and keeps costs low for investors to trade stocks, ETFs, options, and even cryptocurrency without paying commissions. But how true are these claims? It turns out that they are not true at all. Let me set the stage by showing you an article from Robinhood's own website that explains their business model. I'm going to post the link in the description box below so that you can also check it out. I quote from their statement here. When you buy or sell stocks, ETFs, and options through your brokerage account, your orders are sent to market makers for execution. To compete with exchanges, market makers offer rebates to brokerages. Market makers typically offer better prices than exchanges. This means that Robinhood receives money from market makers to send your orders to them for execution rather than sending them to actual stock exchanges such as NYSE or NASDAQ. Market makers are the middlemen in the financial markets. They will rarely offer you better prices than public exchanges. Let me share with you what market makers do so that you can see my point. Number two, who are the market makers? Market makers are high volume traders that literally make a market for stocks by always being ready to buy or sell. Making a market means matching buyers and sellers. For example, used car dealerships are market makers because they buy used cars from some people and sell them to others. This is how used car dealerships make money. They buy used cars at prices lower than the market rates and then sell them at prices higher than the market rates. The benefit they offer is that they provide liquidity to the market, meaning that at any point in time, you can sell your car and get cash. The cost of this service to you is that you're not going to get the best offers from them. Very much in the same way, market makers are the used car dealerships of the financial markets. They buy shares from the sellers at the bid price and sell them to the buyers at the ask price. The ask price is always going to be higher than the bid price. Therefore, market makers profit from pocketing the bid-ask spread and they benefit the market by adding liquidity. So whenever your orders are handled by the market makers, you will pay the bid-ask spread even though the process might not be transparent to you. Number three, how does Robinhood charge commission through market makers? To understand how Robinhood charges hidden commission fees, we can trace how a simple order is fulfilled. This schematic shows 6 steps to facilitate a simple transaction through Robinhood. This is a super simplified view of the market just for the illustration purposes. So bear with me, I will address the complications later. Let's start with the first step at the lower left of the screen. In step 1, a Robinhood user decides to buy one share of the company XYZ. Around the same time, as shown in step 2, another Robinhood user decides to sell one share of the same company. Robinhood accepts both these orders and sends them to the market maker as shown in step 3. In step 3, the market maker pays a commission or offers rebates to Robinhood to have the privilege to execute these orders. In step 4, the market maker purchases the share from the seller at, say, 95 cents and sells it to the buyer at $1.05. Therefore, the market maker matches these two orders and pockets the difference between the bid and the ask price. In step 5, the seller receives the money from the market maker through the Robinhood platform. In the same way, in step 6, the buyer receives the share from the market maker through the Robinhood platform. In reality, the mechanism is way more complicated than what I described here. For example, it is unlikely that the market maker would receive the same matching buy and sell orders at the same time. So they usually manage a book where they maintain enough shares of stocks in their possession to facilitate all kinds of transactions. Nevertheless, they always make sure that they charge the bid-ask spread on all transactions. Another important point to note here is that even stock exchanges have bid-ask spreads. However, the bid-ask spread is lower when you are dealing with big stock exchanges rather than market makers. That is why market makers are willing to pay Robinhood for the privilege of executing your orders. In other words, if you were to execute your orders through big stock exchanges, you would have had a narrower bid-ask spread. Market makers are also connected to many brokers and receive orders from many sources, not just Robinhood. Finally, most order matching is done by computers, so it is really efficient and scalable. The main takeaway from this presentation is that Robinhood trades are not commission-free. That is just a false marketing statement to deceive people who are not familiar with how the financial markets operate. You do not pay commission fees, but you are charged higher prices for stocks you buy and receive less money for the ones you sell. Since the stock prices change rapidly, it is very difficult for Robinhood users to notice that they are not getting the best order executions. Professional traders would never use a platform such as Robinhood because they understand what is going on behind the scenes. I hope that you liked this video. If you have any feedback or suggestion, please add them in the comment section below. And don't forget to like this video and subscribe to this channel and hit the notification bell so that you don't miss any of my future videos. Thank you and take care. In step 3, the market maker pays a commission or offers rebates to Robinhood to have the privilege to execute these orders. In step 4, the market maker purchases the share from the seller at 95 cents, which is the bid price, and sells it to the buyer at $1.05, which is the ask price. Therefore, the market maker matches these two orders and pockets the difference between the bid and the ask price.